And so do you have a guide or like?
Yeah, so we're going up. We have a guide that comes with us, but we have it's they show us the way, right, and everything, but it's all our own equipment, everything. All our own guns. They go up and we use their horses and they take us through the backcountry, but we're using our tents, our everything.
And so if you need to be in touch with like the world, just no way?
I have a satellite phone that I can get an emergency thing out, and I have like this huge insurance policy that backs me for like $1.5 million for emergency evac out of the backcountry. But that's it. That's what we have. So if things got super bad, we would like get attacked by a grizzly bear or something. We would have a way out, but it's intense. It's not. It's so.
Is this the first time you've done this trip?
First time I've done this one, yeah.
That's crazy.
So I've done backcountry stuff through Alaska. Lots of backcountry stuff out here in Idaho. I spend weeks out, but never Canada, never the Yukon and BC, northern up there. It's been more like a dream of mine. And my son said that he wanted to go hunting for his 13-year-old coming of age trip, and so I said, "All right, let's do this thing."
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 13 of Drunk Real Estate. Is it Drunk Real Estate? We're so early right now. Is anyone actually drinking today other than me?
Thanks to AJ, we had to do this like super early. I think it's like lunchtime for most of you guys.
Well, I gotta introduce my dashing co-hosts over here, punctual co-hosts. Everyone was here on time. I'm very impressed with that. But we'll start with Jay. Jay, how's it going, Jay?
Everything is going great. I just want to remind people, or not remind them, but I'm going to ask a favor. So we're getting real close. Most people download this, don't watch it on YouTube, but we're getting close to 500 subscribers on YouTube. And 500 is like this big milestone for me for some reason. So anybody that's like happens to be watching this on YouTube, hit the subscribe button. If you're listening on some other platform, go visit us on YouTube and hit the subscribe button. I want to get to 500 this week.
You're just a taker, Jay. You always just take.
Jay, you're new to YouTube. You're supposed to add value to the audience first before requesting to subscribe. You can't just come out and ask for it.
Anybody that subscribes will get a free 2-hour personal legal consultation with Mauricio.
Does it count? Does it count when you unsubscribe and then subscribe again?
Well, how about the value is what you're drinking today, Jay? What are you drinking? What do you recommend?
I'm drinking water today because it's early here and I'm fasting. But I want to know, Mauricio, did what I just say, does that constitute a contract? Like, are you going to be held liable for that?
I tuned you out, so I don't even know what you said.
Good enough.
All right, Mauricio, you drinking anything today?
I am. I just realized I'm drinking 26 grams of added sugar in my vitamin water, 2013 XXX acai blueberry pomegranate.
Acai.
Whatever. What are you, Brazilian or something?
That's just how it's pronounced. All right, and finally, AJ, you got actually something interesting other than water for us?
I do. I have Diet Coke, right? Fountain Diet Coke out of the fountain machine here.
Vintage 2023.
Yeah.
Well, it's just to hold down the fort here, I actually, since it is early, I'm not going to be drinking straight liquor, but I went with a little Southern Tier Brewing Company, little IPA, session IPA. So I guess I'll be the only one so we can still call it Drunk Real Estate. And in that spirit, why don't we start off with a doozy this time? Let's start off with the Chinese economy. Why don't we? Because for the last few years, many people all they were talking about was the growth of the Chinese economy, how they were going to overtake the United States. We better watch out. And now the talk has kind of shifted to, is the Chinese economy in trouble? A lot was put into the Chinese economy reopening, and this is going to be a big thing for the global economy, and that kind of just fizzled. So where are we at, AJ? Let's start with you on the Chinese economy.
Yeah, so there's a few things going on. First of all, the longer term trends, and then more importantly, what everybody's looking at today is the short term trends. And really, this is a story of a classic bubble. This is a real estate crisis, and plain and simple, a real estate crisis that was spurred by speculation and government overspending. But the four main categories are real estate market, government debt, localized government debt, demographic decline, unemployment, consumer exports. Really, these are the struggling areas of the economy. And the Chinese government says 5%, but most people are saying that today their GDP is probably only going to grow by 3%. Now, you're talking about a country that at 5%, that's half of what it was like 5 years ago, right? At 3%, that's a huge decline from what we've seen from China. And the boils down to a few things that are really telling. First of all, the era of hyper growth, it may be coming to an end if it hasn't already just been completely stopped. The overall problem we have on the long-term side was China was very late to industrialize and to be added in to the world order post America becoming the reserve currency. They only did this in the 90s. So basically, China had a catch-up period to get all of these economic fruits that they'd been avoided forever. And that was, capped by China was totally impoverished. It was very much controlled. Not that it is now, but it had skipped out on all the global growth. When it plugged in, that was like steroids. And all of a sudden, it just shot up, trying to catch up to the rest of the world. That now has basically equalized out, meaning that all of that catch up now is gone. And now they're coming back into more traditional economic drivers that are really dependent on itself. And that's where we're seeing things peter out. So if you look at, we could start off with the real estate, because that's, the big piece here that we're showing. Right now, you have a real estate economy that is the absolute heart of the country. Now, to put this in perspective, 30% of this country's GDP is driven by real estate. 30%. Now, that is 17% in America. So it's almost twice the percentage of GDP that America has. Residential real estate sales have dropped by over 43%. You have major companies that are going defunct. You have home sale prices that have been crashing. You have so many vast empty homes that aren't filling up. Developers are going under. They're just shuttering all of these empty.
They have like those ghost cities, AJ, right? I mean, they have ghost cities where they've built all this inventory, and there's literally nobody living there.
There's nobody, because in China, an individual, to obtain wealth, there aren't open public markets. There isn't an open markets where you can create. I mean, it's all controlled. It's totally communist, right? So there's very few options. And the major option in China for an individual to create wealth was through housing. So what you had is complete speculation, and wealthy people were all buying housing to rent out, and they were pre-buying them from developers that would eventually develop them. So developers were building multiples more than needed because people were just trying to put their cash somewhere where they could get anything from it. And that drove obviously a massive housing market after China's growth had been booming. And finally, you started to get a semblance of a middle class and people that actually had money. So this created this ginormous housing bubble, right? And that's really triggered this huge start to collapse. And we're starting to see a lot more. I mean, the local government debt, which is the next one, is something around 92 trillion yen. That is 76% of total economic output in 2020. But from 2020, it's up 62% or from 2019 and 2022. So the local government debt has just soared to 34% of China's GDP. Now, to give you a comparison, that's very similar to something like the United States. And we have the reserve currency, And we actually have a very dynamic economy and everything else, which
But doesn't China have like trillions in reserves though? Like I thought they were like, if you talk about debt, like don't they have like trillions in reserves? Because I remember back in, was it the early 2000s, then they had that banking crisis. Like instead of like what the US did is they printed money to cover it up. They just pulled from the reserves to cover it up.
no, in the year 2000, their debt was 23% of GDP. So since then, it's ballooned to over 34% in 2012. In a 12-year period, their debt soared to that level.
Hey, AJ, before you get on to the other two, though, maybe we should draw the connection, because I can imagine some people are listening saying, so what? What does this have to do with me or the U.S.? I mean, draw the connection of why any of this really matters for somebody here who's listening today or who lives here in the U.S. Like, what do I care what's going on in China?
Yeah. So China is first of all, China and the United States are very much attached. Now, the United States has basically been trying to separate from the Chinese economy. We made a lot of large deals with China early on as we were trying to move them over here. They buy a lot of our debt, and we supply a lot of the overall economic output for China. Now, the United States, right around 2010, started to deleverage, but not deleverage, but get away from that. And since then, the United States has used public markets that are owned by us to buy our debt. So that now is totally watered down. A lot of people think that China owns all of our debt, which is actually not true. The vast majority of debt that we have in the United States today is held by you, me, and all of us. These are massive public pension funds, everything else. We're supplying our own debt at this point, but that did not used to be the case. The vast majority of it was being bought by foreign nations, and particularly China. And the reason why they were doing it was to balance out their overall debt profile and stabilize their currencies. Now, China it's gone through this revision. It's been buying less. We've been buying more of our debt, and they have been taking on more debt as their country has started to peter out. So as their economy is no longer being driven by massive growth, they have been supplying this with debt. One of the major problems you had with the Chinese debt is each province and each city being a centrally run system, a communist system that's centrally dictated. If you have a city and you want resources, what do you have to do? You have to get permission that those resources are being delivered. And so what China did was each location ended up fudging numbers. So each city and each province ended up fudging how much numbers there were because it was predicated on a per capita basis. So what actually ended up happening was the local economies were rigging the system. And then you had over now a 2-decade period of time come to find out that every city was overestimating their total heads. And the reason being was they wanted more resources, to China realizing in the last 5-6 years that they have had a total collapse in population. And to give you any idea, there's some estimates that this miscounting is like 250 million. Like, this is ginormous.
But isn't like, I mean, I don't want to make assumptions, but isn't that the root of the slowdown in their growth? Like, I think China's like birth rate right now is like 1.03 or something, and like they don't have the US like draw. Like the US has all this immigration because everyone wants to come to the US. China doesn't have that. And so when you have that kind of population, then it's like, look at the housing market. Like if you want a case study of what happens to a housing market when all of a sudden there's no population growth, like just look at China. They had all this population growth before, and then they did the one child policy to try and keep that under control. And then look what happens.
No, you've hit at the heart of the problem. I mean, this is going to collapse China over the next decade. And we're already seeing it. It's already starting to basically collapse in on itself. The unemployment rate for youth is astronomical there. They literally can't get jobs. Like,
well, it's not that they can't get jobs. It's that they don't want the jobs that the government wants them to have. There are all these kids that are going to college. They're getting technical degrees. They're getting engineering degrees. They don't want to work in the manufacturing jobs. And that's what their economy is based on, manufacturing. And so basically they can't fill the manufacturing jobs. The kids don't want to work in the factories, and they have a 20% unemployment right now. It's crazy.
Well, and you can't fill it up. So this massive gap between elderly people and young people that China has, right? You're not going to, their liabilities are no longer being able to be fulfilled by a new generation coming in. Hence the reason we're seeing massive spikes in debt. We're also seeing output just completely dwindle. And once they've got off that juice from the rest of the world, they have to be self-sufficient. The reason the United States has boomed is because of a middle class, right? They had a huge population that we were growing. They bought more houses, they had more kids, and that created demand. Well, China now doesn't have that, which they were getting all that growth from America and elsewhere. But then as their cost rose, all of a sudden their competitiveness in the global market failed. And we start moving everything from everyone from everywhere from the Philippines to Mexico. We're diversifying, we're pulling back tons of stuff. It's they're not sure what to do with it. They do not have the population to boost that GDP anymore. So it's a combination of long-term trends that are creating short-term crises.
And I think that's one of the big things I noticed is that, for all these years now, the number one export that China really has had is cheap labor, right? And that's, to your point, AJ, is no longer the case. I mean, it's still a big driver of it for the rest of the world. But to your point, people are now starting to diversify a little bit to the Philippines and even to Mexico, which makes a lot more sense for the U.S. because it's so close to our borders. But the cost isn't as cheap as it used to be. To your point, everybody's coming in. Jay, you mentioned people don't want to have those jobs. And so, between the population decline and the fact that the kids don't want to be in manufacturing, it creates, I think, an upward pressure on the cheap labor isn't as cheap as it used to be, which does put a lot of pressure, will eventually put a lot of pressure in the US, because if labor goes higher, like maybe they go to Mexico, but Mexico labor is higher than the old Chinese labor, then your input costs go up, which causes inflation for us.
So Mexico acts more skilled workers than China does. They actually have workers that know how to do this stuff.
To put some numbers behind it, wage growth in China has gone up 15 times in the past 20 years. And so, which is great for the Chinese people. But there's going to be a whole lot less demand for their products overseas. You add that to the tariffs that have been implemented, which is going to increase cost. You add that to the fact that we've seen global growth slow down since 2018, 2019. There's all this reshoring in the U.S., all this desire to bring back manufacturing to the U.S. And over the past year, we've seen double-digit drops in imports and exports from China, and it's just unsustainable. Going back to talking about the population growth, I was reading something the other day that said by the end of this century, based on the trajectory that they're currently headed, they're going to expect the number of workers to drop by 2/3.
Yeah, it's a population collapse.
Yeah, and their population is going to be down by 50%.
Yeah, Jay, we did an episode. Yeah, we did. I forget which one it was, but we did an episode on demographics and people, and China was a big part of that story. I actually heard, and then I know, AJ, I want you to get back to the last two things you had on your list, but literally about 6 months ago, I just pulled it up because I was listening to Joe Rogan. There's this guy, but I never heard of him before, Peter Zion, which now I've heard a little bit more of. He's a geopolitical analyst, and he was saying that China they'd be done in 10 years. And I was like, when I heard that, I'm like, what is this guy smoking? Like, what is he talking about? And I was like, there was a brand new info for me. But now as I'm digging more into it and seeing this massive population problem, demographic problem that they have, maybe he's right. Maybe in 10 years, China's going to be nowhere near where they are today. I don't know.
Well, my question is, AJ mentioned before about how that China was playing catch up, basically infrastructure wise and housing wise. So they've spent all of their money, like the government, on infrastructure and housing are the two major things that they've spent. And so my question is, has it just caught up? Like, have we just gotten to that point where they've basically, they planned for all this growth and they built all the infrastructure, they put it on the housing, and then they haven't seen the population growth. So is it just bottomed out that there's nothing else they can kind of invest in infrastructure wise, and they're just stuck?
Yeah. And you're stuck is a perfect word for the Chinese government. They don't have the ability. So like right now they're lowering interest rates. They're trying to spur the market, but the fundamentals of demand are gone. And when you look at,
Could they do stimmy checks?
they did. That was part of the problem. They did stimmy checks that bloated up the economy for the last like 10 years. And they've been trying to get that housing market to go up. And they're instead now they're tearing them down.
And they're subsidizing housing for first-time home buyers.
They're pulling out everything they can, and it's not moving the dial. They've got, to Jay's point, even when you look at this unemployment, what's going on, it's gotten so bad that in July, China actually stopped reporting. They just said, we're not going to do it anymore. They refused to report it because it's so bad.
It's classic China, though.
Yeah, classic China, right? And I think that the reason that we see like 2030 going from this era of they're like, yeah, China's going to take over the world. And the gap was an information gap. We had such a massive hole that I don't think we realized until the last 3 or 4 years that's now coming out years short to the tune of 100+ million people.
Well, because they didn't want India to be reported as bigger than them. That would be like recording like a loss. So they've just stopped reporting so that India wouldn't be officially a higher population.
And I think it already just passed it.
And by the way, Mauricio, you mentioned Peter Zehan, or however you say his name, and yeah, he that Rogan interview got a lot of views earlier this year. But just for some perspective there, for 20 years, he's been calling for the collapse of China. And back, I think it was 2010, he said 3 to 5 years and you'll never hear of China again. So I'm not saying he's wrong.
That's good perspective. Yeah, no, you're right. No, 100%. Yeah, it's like all the gold guys that are saying it's going to something. I've been talking about that for 20 years.
So he may be right, but I don't. His timeline might be a little aggressive.
Yeah, and I think China was able to patchwork things with government. And I think those are all starting to fail. So when you look at the last real true measure of this, we've got the proper, so real estate markets collapsing, right? The local government debt, which now they're being strapped and they're not having a lot. Hence the reason when you see BRICS and all this other stuff too, by the way, why China's trying to lead the way, they're trying to get out of their own hole. And so when you look at the demographic decline, unemployment, that obviously leads to consumption and exports. The annualized basis for household consumption in the first quarter of this year fell by 50%. It was at 33%. It is now 15%. So they're now seeing even the households. I mean, it's a crater, right? I mean, it's absolutely cratering. So you've got then consumption now. And what they're doing is okay, we're going to do car, home appliance subsidies, extending restaurants hours, promoting tourism, entertainment activities. The Chinese government for the last 2 years has been basically begging people to buy things. And we've now seen in the first quarter, all of their COVID stuff that they had all this strict, which masked so much of this problem, completely masked it.
Good little pun there.
Yeah. That is good. But now that it's completely open, they're really finding true numbers out. And once again, consumption at half. Now in the United States, when we came out of lockdowns and everything, consumption exploded, right? China didn't. There's actually no pent up demand. So you're starting to see this air just be taken out. And what was really masked in COVID is now starting to come out. And it's not a good picture for China. It really is.
Here's my worry, though. There's been one tried and tested true method of boosting your economy historically. And what's that? War. So we've had those inklings of China and Taiwan, what's going to go on. The US has done an okay job of kind of not poking the bear there. They've kept their stance. We had a little bit of a hiccup there with Pelosi, but other than that, like, we've done a pretty good job of staying out of it. More so than the Ukraine war. I'm just worried that they're going to get in a hole and they're going to go after Taiwan.
Well, Kyle, the number one exporter of Taiwan, the number one reason we care about Taiwan, what is it? Chips. And how much money did the U.S. government pump into chip manufacturing in the last 2 years in the United States?
Yeah, but we got a ramp up period there. We're not anywhere close.
We're not anywhere close, but Arizona next summer will open up their $50 billion chip manufacturing plant. And I was out touring it 6 months ago. It's something to behold. I'm not even kidding. It looks like they built a city. It's shocking.
Do they need self-storage to store all those chips, AJ?
Yeah, I'm building one right there, so don't worry, I got it.
I mean, Vivek Ramaswamy, the GOP candidate for president, he got himself into a little bit of hot water a couple of weeks ago when he basically said, "Yeah, we need to support Taiwan until we get our chip manufacturing taken care of here. Then screw them. We don't care anymore." And so yeah, it's
You can think that, you can't say it though.
exactly. And I think a lot of politicians are thinking it. We have to protect Taiwan for that very reason. And so yeah, that's a good point.
The what? The territory of Taiwan or the region of Taiwan, or what do we call
Wherever
it?
the manufacturing plants are, Kyle, just like wherever they are, we'll protect that.
Because we can't call it a country.
Oh yeah, that's right. China will be very upset at us. We'll have to make a public apology video like all the stars have to do.
John Cena, did you ever see that? The John Cena video?
Yeah. What a joke.
I watched it because I thought I was going to like make fun of it. He could actually speak like, what was it, Cantonese, like very well.
Yeah, that was pandering to the highest.
I went there trying to make fun of him, and I was like, oh, I came away impressed. So the question, I guess, that we get down to is, should we be worried as a country and as investors about the situation going on there?
I think so. I mean, you're talking about one of the largest economies in the entire world. You have China, India, the United States, and then Europe as a whole. But I mean, this is the stuff that Kyle's right. You're shifting total world order systems. And whenever you see major countries like this start to go into downfall stuff, problems happen, right? They do things that they would never have thought about doing when they weren't. And now they're getting backed into corners. And two, when you have a centralized command system and regimes like this, it'll never be their fault ever, right? And so they will always place the blame. And I think that's why we see the backing of the BRICS. That's why we see the backing of Russia. And that's why, all of these things, we have the highest tensions with these countries around the world that we've had not only in our lifetime, in our parents' lifetime. I mean, we're going back to we're going back 100 years almost. We're going back 80 years to these kind of geopolitical tensions that.
So how is this going to manifest though in problems in the United States? Like, are we going to just see inflation, or are we going to see like what's going to be the problem that we're going to have to deal with?
I think it would be twofold. I think you have a problem of, you're right, Kyle, shortages and things that we look at, supply chain issues. That's obviously a big one. But I think you have other problems from company. I think the tipping point was Hong Kong. So when China basically went back on all its agreements, took over Hong Kong, they centralized the overall economy and banking. You had mass companies flee. So the Chinese market for so many of these major corporations and so much infrastructure in the United States, we've been putting hundreds of billions of dollars into for the last 15 years. And that stuff's kind of coming unraveled. People are walking away, reinvestment. And I think the consumers, we would feel it. I think it has debt implications because so much is cross collateralized. These banks have funded so much. So I don't think we actually know obviously what the outcome will be, but I think it'll probably hit in lots of ways that we don't even think about today.
Yeah. I mean, I think if you think about it, we live in a global economy now. And if a significant percentage of the population is struggling, if a significant economy is literally seeing deflation because there's so many unemployed and so many people that don't want to work, it's going to have a global impact. Now, what is that going to be? I don't think anybody knows. But keep in mind, the U.S. has done a really decent job of starting to put together a plan for manufacturing chips and for reshoring a lot of the manufacturing. Not that we're doing it yet, but we're talking about it. And we're resilient enough that should things go to crap with China, we'll be able to bring a lot of that stuff back home and be able to do it ourselves, even if it's expensive and it causes inflation. There are a lot of countries out there that don't have the natural resources, that don't have the manufacturing processes, the scientific know-how to do that. And they rely on countries like China to basically import a lot of that stuff. And if China can't provide it to a lot of these other countries that can't be self-sufficient, then we're going to see a lot of struggle around the world.
Well, the other way around too. So Brazil's economy ended up basically being like a lot of places in Africa, ended up being just supplying China's growth. That's it. And so when China's growth rate slowed down, it put Brazil into a depression because China stopped pulling out all of its natural resources, goods, and services. And it literally, you had a contraction of 50% in China's GDP, and it put Brazil into a depression. So it goes also the other way around.
So last thing I'll say here is that a couple months ago, we talked about the de-dollarization. And there's a lot of talk these days about is BRICS going to come in with their own currency and hurt the dollar? And Mauricio was pretty adamant that we didn't need to worry about that. Well, between China's economy kind of going down the tubes and Russia being preoccupied with this little war on their side of the world, it looks like what Mauricio was telling us a couple months ago is at least short term coming to fruition. And I don't think we need to be worried about BRICS right now.
Yeah, well, don't forget the BRICS just had a big summit, and we had some big announcements, new currencies and coming out of there, and gold back. Oh wait, no, none of that happened. Sorry,
none of that happened.
They just had a meeting and went home.
And we thought that they were going to be adding new countries too.
Russia didn't show up, and Iran was a guest speaker.
I think China skipped one of the important sessions too.
Well, still something to keep an eye on. So why don't we move on to some more local news? And since we have our SEC attorney, we love talking about SEC stuff. So August 23rd, the SEC adopted a modification to the regulation of private fund advisors from 1940. So they waited quite a while to make an update. This new rule requires a bunch more disclosures and information from GPs, but also requires extra steps such as audits and things like that to be performed. And luckily, we have our own little resident SEC attorney to give us some free insight into these new changes. So what's going on here, Mauricio?
Did he say little SEC attorney? Is that what he said? Little SEC?
In stature, not in intellect.
Look, I don't think either way that's good.
I'm going to make this short and sweet. I don't want to bore everyone with like legal, Securities and Exchange Commission, but look, I think it's come on people's radar. And what I wanted to do today is kind of put people at ease that you're going to be hearing a lot about this new rule, which literally, to Kyle's point, came out on the 23rd, like 5 days ago. But the good news for us syndicators, at least the vast, I would say 99, if not 100% of the people listening to this show and watching the show on YouTube, and per Jay subscribing to the YouTube channel, so we can fulfill Jay's request to get to 500. The vast majority of this new rule doesn't apply to us. So that's kind of what I wanted to really emphasize on this thing, is kind of put people at ease. So for example, all of the stuff you just mentioned, Kyle, doesn't even apply to anyone who's not a registered investment advisor. And so the way the fund advisors work is that you're either a registered investment advisor or you're not. And at least in my world, we don't work with any registered investment advisors. All of our GP clients, they have some kind of an exemption to it, or they don't actually register. And so 85 to 90% of this new law doesn't apply to them. And then in addition to that, this only applies to what we've been talking about lately about fund to funds, right? It doesn't even apply to a regular fund, because in order to be a fund advisor, the definition of a fund advisor means you need to be advising your fund as to the purchase of securities. So if you've got a real estate fund, which is what we're mostly doing, you don't have it. You're not investing in securities. You're investing in real estate. You don't have to worry about any of this, as I like to call nonsense, the Investment Advisory Act of 1940, the Investment Companies Act of 1940, and registered investment advisory rules. All of that stuff doesn't apply to you unless you're in the business of buying securities. And in our world, the only time you're really buying, nobody's buying stocks or investing in financial instruments like that. We're basically doing investing in other people's syndications. In our world, that's how it comes up. And when you do that, you are buying securities. So this is very limited. Even the statute alone, this new rule only really applies to syndicators who are doing what we call the fund-to-fund models, where they're raising money into their fund and then they're going out and investing into other people's funds. So if you're not doing that, none of this applies to you. But if you are doing that, 85, 90% of it doesn't apply to you. The only part that really applies to you, because it applied to all fund advisors, whether you were registered or not, has really two categories. One is there's certain fees that you're now no longer able to charge, but those aren't the fees that you're used to. I mean, if you're charging an asset management fee, or if you're charging, acquisition fees, all that kind of stuff, that's fine. It's only when it's really almost like reimbursement of fees. If you have to pay fees to comply with your regulatory and compliance fees, then you can't charge that to your fund. Or if you're, anything that has to do with, examinations that you have to, go under, there's some fees you just can't charge. But again, in our world, I don't think it's going to affect us. Where it really is going to affect us a little bit, I would say, is the fact that you can no longer do some side deals with some larger investors without disclosing that. So it's not uncommon for some of our clients to, if they get a huge institutional investor or maybe a private equity group or somebody who can come in with a large, significant amount of money, then it's not unusual for us to kind of cut not a side deal, but a sort of giving up part of our GP, for example. It's something that, hey, I'm getting a 20% split on this deal. I'll give you 5%, in exchange for certain things. Those side letters or preferential treatment that we sometimes give institutional investors, you won't be able to do that without disclosing that now to all of the investors, right? So that's a disclosure requirement. And then in terms of redemptions, which again, not too many fund of funds use a redemption model. Again, this is primarily meant for hedge funds. I'll give you a funny story that the rule actually separates a large fund from a small fund. You're a small fund if you have less than $1.5 billion in assets under management. Just to give you an idea what world we're playing in, right? We're talking about huge hedge funds. We're talking about venture capital funds. We're talking about these companies. Most of us doing syndications where you're raising 10, 20, 30, $50 million. This really is nowhere near caught up on this regulatory. But side letters are going to be affected. And then if you're structuring your fund with redemptions, for example, also there was a lot of times you would give some preferential redemption rights to big institutional private equity groups that come in. You're no longer going to be able to do some of that preferential thing. But again, not to get in the weeds, I just wanted to kind of really assure people this is going to come up. So hopefully they'll be able to find this podcast and say, oh, hey, have you heard about this new fund rules that everybody needs to apply with these audit rules like Kyle mentioned, all these other things that we have to do? Point them towards this podcast. I'm going to do my own actual little plug. I'm going to do a deep dive on the Real Estate Syndicator Live on Wednesday. But it's for most of us, it's really much ado about nothing because it really doesn't apply to us.
I looked at this as kind of a good news, bad news too, just overall. As you said, it doesn't really apply to us, but the good news was there was actually quite a bit more proposed on this. Yes, they restricted some fees, but there was a lot more fees that they were looking to restrict, and those got thrown out. And the one major one that I saw is they were trying to loosen the regulations around LPs actually suing GPs, and that got thrown out too. So that I take that as a big win that you could say the private placement lobbyists won a little bit in that case, where that would have been a tough one if all of a sudden the regulations around suing GPs were loosened.
Yeah, but Kyle, remember again, when we think of LPs, I know we're in our world, right? We're thinking of 50,000. You guys all have your LPs. They're putting in 50K, 100K. These LPs are all institutional qualified investors putting in $250 million minimum investments. I mean, these are big boys and big girls, right? These are sovereign wealth funds that are coming in and putting money in, right? So it's just a good reminder to us that we play in such a small area of securities laws. There's so much out there, whether it's, like I said before, venture capital firms or private equity groups or hedge funds, that we sometimes forget that we really do swim in a little corner of the circle that we call SEC compliance.
Yeah, but but the loss that I saw for the industry here was just the fact that the SEC is focusing on this stuff anyway. Like, to me, there's so many other things that they should be focusing on, and the fact that they're trying to overregulate this area, it to me is just a big loss, because whenever the government steps in and regulates, it's always just hurts the little guys, right? Like, they're always more regulation just makes it more red tape and more costly for smaller people to get in, play in the big leagues. It doesn't really affect the big league players, and it just makes it tougher for everyone, the little guys. So the fact that they're even focusing on that is, kind of sucks, to be honest. But because they could be focusing on the whole accredited investor thing. That was a bit of a flurry, and that's still making its way through the SEC. And to me, if you're going to try and shore up that whole industry, you focus on that and getting people more educated and changing the regulations around that, updating that's going to kind of change the same or have the same effect as regulating the other side.
Yeah, or just trying to make it easier for people to have access to these investments, or just trying to facilitate the whole process as opposed to making it harder and harder and harder. To your point, the little guy always ends up losing. Or they could focus on, I know a lot of people, not everybody's interested in this whole new world of blockchain and cryptocurrency, but that's the wave of the future, and we need to get some clarity on that. And they've been sitting on that for, well, not about sitting, they've been kind of refusing to really address that. And so now, Congress and those guys have started to put up some proposed legislation dealing with that. But you're right. I mean, I'm not as an SEC lawyer, I'm not a big fan of the SEC in general. And, I think, less regulation is better, as I think probably most of us will agree here.
AJ, Jay, any comments?
Oh, I tuned out when he said it didn't affect us.
Yeah. I was like, oh, great.
AJ's like, as long as it doesn't affect my fund for my self-storage
both
deal,
of you guys, both of you have a fund of funds, don't you, in some capacity?
I don't, but it does affect us in the fact that we would team up with fund of funds. And two, it's, this also represents a issue on that we have to watch closely, hence the reason why Mauricio's our attorney. But we look at, okay, having this layout, how do we scale as a company? So there's multiple avenues of getting capital as a real estate investor and how to scale. You can go institution, single source, right? You can go with more individual accredited investors. And there is no really right or wrong way. Going with fund of funds and doing an actual more of a matchup for us as we're planning out over the next 3-4 years, what capital should we take? How should we take it? How are we going to deploy it? Right. It is a big consideration. Now, we're not a big boy, right? We're very small players in this world.
You don't have 1 billion in assets?
You have less than 1.5 billion, AJ?
Give me a couple years, Kyle. 2 years. But it's when we look at it, it's the fund of funds and outside capital that's affecting us. If you're talking to institutional players that want to come and seed funds, things like that, they're going to be affected by this stuff. And so it is a big deal. And it starts to make you worry because some of the rules and things that they have proposed would fundamentally alter the way our business could even operate going forward, how they classify accredited investors and where we have to get capital from. So I'm glad they didn't do very much that affects us, but there has been a big push by the government lately. And we've seen an absolutely coordinated effort from institutions to go after more of mid-range private equity groups. We've said, the last 2 months was just one after the other. The SEC, the Wall Street Journal, Business Insider, basically saying, unless you're worth billions of dollars in assets, you're not a good player. Just completely ludicrous things that they're even talking about and almost talking down to an industry. The reason being is it's growing so rapidly. So our industry, who we are, is blowing up, right? And I think that is going to continue. And I think that these laws that are directed from these much larger operators will have less of an impact at broad, meaning that the smaller guys that have a few $100 million in assets are going to start to make up a bigger portion as a total group. And then it's sure enough, it'll come down, but we don't have the infrastructure to fight like somebody that has, 50 billion in assets. We don't have the legal teams. We don't have, that goes to margin for us. So when that regulation comes in and these rules, we have to become compliant. The work and effort to administrate this, we all of a sudden can't do it at certain levels. I can't take your 100,000 anymore. It's not worth the liability. Look at unaccredited investors. We would love to take unaccredited investors. It's not worth the liability for us. We do not have things set up. We're not going to do it. So who ends up getting hurt? It's the unaccredited investor that would love to put his money into great, stable, cash flowing deals, but nobody will take his money.
Yeah, and to your point, AJ, it does have that chilling effect. Even in your case, just to kind of, you mentioned this, I'll single you out, but like if you're having discussions as to how do you scale your company, how do you grow, and you want to grow, and you're trying to get, to your point, other institutional investors to put more money into your deals, well, that's a fund of funds for them, right? And if they have more restrictions now, hey, I'd like to invest a bunch of money with AJ, but I'd like to have a side deal with AJ where he gives me a piece of his cut, or I get some preferential treatment because I'm coming in with, $100 million. Well, this regulation does affect them, which then dissuades them a little bit more to coming in and putting money into AJ or anybody else who's looking to scale to get to the next level. So it does have that chilling effect.
They want certain amount of reporting done. They want certain amount of things that we have to execute on that we may not have the infrastructure and ability to do.
But at least it seems like we have some people working on our side, because what really came of it is we just have to disclose that stuff, right? Like, it's not like it's restricting us at this moment. What the concerning point is that they're even going after it at all. And that's where they're focusing. So
that it got thrown out, right? We were lucky that it got thrown out, but
exactly. Well, we got to get Jay back involved here. So why don't we move on to Jackson Hole?
Jay's falling asleep over there. Jay's been falling asleep since we got on here, and I've been fighting the negative energy. Jay, because you're on. Oh, I forgot you're on your
fasting.
You're fasting. No wonder. That's right. He's so grumpy.
I'd be grumpy too if I wasn't eating any food.
Who's grumpy? I'm happy.
Well, let's get you back involved here. We'll talk about Jackson Hole, because the Fed held their annual retreat last week at Jackson Hole, and people were kind of hoping that there would be some big news coming out of there that would indicate where we're headed with interest rates or something of the like, because historically there's been some pretty significant announcements and insights coming out of Jackson Hole. Most recently last year, that's when Powell came out and kind of announced his warpath to get rid of inflation. But it seems like it kind of just turned into another Fed meeting speech, and nothing really came out of it. So Jay, why don't you give us a recap?
Jay, before you give the repat, over under was the Wyoming event, Jackson Hole, more of a dud or less of a dud than the BRICS summit?
So I actually I didn't watch his speech. I don't even know if it was aired, but I read his speech. And
it was only 8 minutes, right? Like
it was short, but I thought that it was I laughed, I cried. It became a part of me. No,
what? Oh boy. Give this guy some food.
You guys don't get that reference. Never mind. So Jackson Hole, basically the Kansas City Fed every year and basically does this retreat, as Kyle called it. I think of it more of kind of a conference. They have speakers, they have panels, and Jerome Powell is the guy that gives the keynote speech, which is really just a Fed policy speech. So last Friday morning, he gave his speech, and typically when he speaks, I feel like he's not very good at concealing what he's trying to say. He either he does it on purpose or he does it because he can't help himself. But he typically does a good job of signaling what policy is going to be happening, where we're heading. Are we leaning towards hiking rates? Are we leaning towards cutting rates? Are we leaning towards just kind of keeping the status quo? But this speech was one of those where he really didn't do any signaling. In fact, I walked out of, or I stopped reading at the end and thought, I have no idea where the Fed is headed after this. And so I don't know if that was his goal or not, but I thought it was a good speech from the perspective of he didn't signal where they were going. Now, that said, a couple things stood out. One, it was definitely a more hawkish speech that I'm used to from him. He was definitely a little bit more aggressive than he typically is with respect to talking about inflation. And I feel like the last couple speeches have kind of signaled that he's very happy with what's going on. Yeah, we have some things that we need to watch and we should still be a little concerned. But inflation's come down and everything is happy and healthy and good. This speech was more, we're really concerned. And yes, we've seen some good signaling. We've seen some good news, but we still have a lot of concern about the inflation that we've seen, the inflation that we're seeing. And more importantly, there was a lot of talk about the current job market. And reading between the lines of what he said, I got the impression that the Fed is not happy about the fact that the employment outlook is still so strong. I got the impression that he expected that, 16 months, 18 months after they started rate increases, that they would have broken the job market a little bit more, which really would have kind of given us some confidence that inflation was under control. But we haven't. And he talked about the fact that, yeah, we've seen some softening in jobs, we've seen lower payroll numbers, et cetera, but that he just isn't confident that the Fed has done enough to kind of break the employment sector to the point where we can be confident that that inflation is under control. He then talked about three specific areas. Basically, inflation numbers, the core inflation numbers, are comprised of basically three areas. Number one is core goods. So things like durable goods, things like automobiles, other just commodities. And basically what he said was, that stuff, basically goods, the stuff we buy, materials, has dropped significantly, but we're still above pre-pandemic levels. And he's not happy with the fact that we haven't gotten down to pre-pandemic levels. Then he talked about the second piece, which is housing. Mentioned that housing typically is a lagging indicator because leases only turn over every year. So stuff they did a year ago isn't necessarily going to impact us until a year later. Typically 9 months is the number we talk about. And so what he said is, we're starting to see the impact on housing. But it's been, again, almost a year and a half. He expected that to happen a little bit faster, a little bit more, and we're just not seeing as much of an impact on housing as he was expecting. And the third piece is this non-housing services, things like healthcare, food, transportation, stuff like that. And basically what he said was, we're not seeing nearly as much movement from an inflation standpoint on these services as he had hoped. And so between these three groups, basically, yeah, we've seen some movement. Things are heading in the right direction, but it certainly sounds like he's not confident that we have tackled inflation yet. And so basically said, hey, we're going to do whatever it takes, and sent the message that I think they're prepared to do more hikes. Now, whether they'll do a hike upcoming in September, a few weeks from now, who knows? Didn't sound like that was imminent. In fact, if you go look at the kind of the market dynamics, the market's still pricing in an 80% chance of no hike in September. But the way he was speaking, it sounds like it's definitely not off the table. They're going to be looking at the data that comes in, the jobs data that comes in between now and the next meeting, the inflation data that comes in for August between now and the next meeting, and then they're going to make a game time decision. And I'll leave it. Let me pull this up. He concluded with this, which I thought was an interesting conclusion. This was a quote. As is often the case, we're navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we'll proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. We'll keep at it until the job is done. So anybody that was hoping for a cut, I mean, zero chance. That's off the table probably for the rest of the year unless something significantly changes. And I wouldn't be surprised based on all of this to see another hike this year unless we get some data that indicates the inflation's still coming down.
You said multiple times their jobs data, but they keep revising the jobs data lower and just sneaking it in and act like nothing happened. Like every single month, if they go back from the previous month and they revise it lower. And then not only that, they do it annually. They do an annual report. And that actually came out last Wednesday. So they revised the March to March job report down by 300,000 jobs. So not only is every single month it gone down, or not only every single month they've revised it lower, then they also had to revise it lower on average another 25,000 per month. So like, and no, he never really mentions that. No one really talks about it. And like, I feel like why do we have to focus on jobs going down in order for the job to be done? If we get inflation at 2%, isn't that job done? Like, I guess I don't get it.
I think from my standpoint, like I've been saying since we started ever even talking about this, the jobs have to come down. The reason being is you have like two ways to really end inflation, right? You have either, or you fill it up, you have a debt restructuring, which eradicates capital out of the market, which has not occurred, not even close to it. In fact, it's arguable that it's even gotten worse. And then you have the other side is the deployment of capital. So jobs represents the deployment of capital, meaning that if you have such a tight labor market that any boost or any capital within the system you can get deployed, it can get used. So there's actually the means for debt to be allocated and start compounding and expand the overall money supply. But when you eradicate all those jobs and you start entering capital back into the market, it is not like a light switch. So I think they're looking at this saying, right now, any changes downward, any changes that the money supply could go up, it is going to go immediately. It's just going to burst, right? And so they need that to end. You either got to fill a hole or you got to get rid of the means of distribution and compounding capital. Right now, literally anything added to the pool of money, it is going to just erupt because you have high asset prices, high cash flow, you still have great balance sheets, and then you have high unemployment. I mean, that's a recipe for compounding, right? And they need people to get fired. That's what they're trying to do. He's been trying to do it ever since.
That's exactly what I mean. That's the classic economic model, which is there's an inverse relationship between inflation and employment. I mean, I'm not here to agree or disagree with it, but that's what the majority, even though that's proven before not to be true, that's the assumption that everybody's under. So Powell has been very clear that that's his goal, is to get more unemployment. I mean, the problem is, and I was listening to, I listened to Joseph Wang, who used to work at the Fed, and he brought out some great points, which is like the tools that they've been using to, attack this problem really haven't been working yet. So the reason you increase interest rates, the overnight Fed rates, is to affect the interest rate sensitive industries like real estate. Like they're expecting, crap, if we're going to raise rates till 5.5, mortgages are going to go through the roof. People are going to stop buying, prices are going to come down. And it's kind of a little bit, but it really hasn't had the effect, especially going from 0 to 5.5. Like, yes, it's slowing down, especially on the residential side, but it's not like real estate's collapsed and it's down 30-40%. Yes,
last time they did it, it did collapse. That was 2008. This time,
right? Maybe 2008, but like right now, residential, yes, mortgage applications are down. Yes, sales volume is down. Yeah, prices are down a little bit, but they're still way off the roof. And same thing with employment. So the theory goes, as interest rates go up, it's harder for businesses to make money. They're going to end up, they're going to start laying people off, and that hasn't happened yet. Now there is a lag. We always talk about this lag thing, and the lag is true. But until he sees everything that's interest rate sensitive, whether it's real estate, employment, until that starts to move bigger, I think he wants to continue. I still think he's not going to be able to. I still think.
But I say this every time, and I'll say it again. If you look historically, the unemployment rate doesn't go up until after the Fed has already started cutting rates, until after they've seen that, oh shit, we have to start cutting rates now. And so to use that as the indicator of when we've achieved, the soft landing or achieved the no recession, I just don't get it. When historically, it does eventually go up, but to your point with the lagging effect is enough that they're already cutting rates by that point.
Right, and that's by the way, that's what we talked about last week. That's the yield curve uninverting, because the rates start dropping, and so the lower end of the curve starts going down. That causes the curve to uninvert. That's what actually gets us into recession. It's because the Fed starts freaking out and starting cutting rates because they realize, just like my shower example, that shower is too hot and you turn the knob to get it cold. There's a delay factor every time you move these levers and these knobs. So I still think there's going to be a cut, not because they want to cut, but you're going to have some issue pop up. I don't know what it is, but we made our prediction show, and I'm sticking to it, that something's going to be popping up here shortly, and that's going to force the Fed to cut, not wait until whenever the Fed's thinking they're going to cut, which seems like it's middle of next year or something, which I think is fantasy land.
He did say something that he did imply for the first time, not for the first time, but it was very clear for the first time to me that he seemed confused about whether they've overcorrected or undercorrected at this point. I don't remember exactly what was said, but he had a couple sentences basically saying, I'm not sure, we're not sure if we've already done too much or if we haven't yet done enough. And that's what we're waiting to find out. And it's interesting that a year and a half in to who would have thought a year and a half ago, we wouldn't know a year and a half later if we had undercorrected or overcorrected going up 5.5 points.
But Jay, didn't he say like I correct me if I'm wrong? I thought there was something like a hint of that even last time for the first time, where it was more a little. He was starting to bring in this and like almost like, hey guys, like we're really not sure. I can't remember. Right? Like I may have a little forget, but I was thinking maybe last time too. He started to. It was this almost like we're in this weird area right now where we don't have economic indicators enough to clearly define here where we're at now. I'm maybe wrong. Maybe that was just more the sentiment that I felt after listening to it. I can't remember.
Yeah, I think this one and the last one was somewhat similar in that it's pretty hard to tell exactly what he's thinking, and I think it just may be that he's out of stuff to say and he doesn't know what to say, and at this point, it's. I mean, maybe it's. I'd rather, from his perspective, I'd rather not talk for another 2 or 3 months, but I'm forced to get up here and say something, so I'm going to get up and basically be as non-committal as I can. And I thought he did a good job of being non-committal. So, what do you guys think? Are we going to see?
I still think, Jay, you mentioned something about whether the rate hikes are off the table or not for the next. I still think the Fed does expectation policy, and if they think that 80% is wrong, meaning 80% of people think they're going to hold steady, if they're thinking maybe there's data that comes out, or they're starting to incline to actually do a rate hike, they're going to send out their people, all the Fed chairs or all the people there to start talking.
But we still have a lot of time. Like we still have 22 days.
100%. And they'll start signaling so that 80% starts getting closer to 50 or maybe even lower by the time the Fed actually has to have
right.
that
But we
meeting.
still have another jobs report. We have in just a couple of days here, we have the PCE. In a couple of weeks, we have the CPI. And so the market's going to do their own thing based off of those things. And so I think they're probably waiting to see, okay, how do these numbers come out? How does the market react? And then they'll send out their minions to influence the percentages.
I just did a quick search in the meeting, the speech, and he used the word uncertainty 7 times.
Be a good drinking game.
It's a drinking game. Yeah, I don't know if that's a lot or a little, but it wasn't a very long speech.
There we go. We'll get together live, Drunk Real Estate, and next time he's doing a speech, we'll drink every time he uses the word uncertainty, and it'll be a good little game to play.
I like that.
All right. Well, let's wrap this up. I got a good top 10 for you. And since we were talking about China in the beginning, let's go with the top 10 Chinese food dishes as based off of Grubhub orders. So what do you guys think?
Kung Pao chicken.
General Tso's.
Orange chicken.
General Tso chicken, number 1. And it's also
What?
the
I don't even know what that is.
most popular dish in general.
Wait. What is that?
Did you really just say you don't know what that is?
Say it one more time.
General Tso's.
Dude, I have no idea what that is. If anybody else has no idea what that is, can you make a comment and back me up here in the comment section?
There's nobody that's watching this that doesn't know what that is.
You're going to be the only one. I agree with Jay.
Really? AJ?
Yeah, I know.
I love you, Mauricio, but I'm going to have to reevaluate our friendship.
I don't even, and I eat a fair share of I like Kung Pao chicken and, whatever. And
so apparently you're weird because Kung Pao didn't even make the list. If you want to talk about chicken dishes, orange chicken came in number 8.
Right. That's fine.
Sweet and sour chicken, number 7. Sesame chicken, number 4. And General Tso chicken was number 1. So a lot of chicken dishes there, but no Kung Pao. Let's go with number 2 on the list was actually crab rangoon, which surprised me.
That's good. I like that. It's good.
I didn't know it was that popular though.
Yeah, it is. Yeah, where have you been? You've been living under a rock. It's like one of the more popular Chinese dishes ever.
Yeah, I just didn't know it was that popular. I have it every once in a while, but it's not something I always see people order. Number 3, egg roll. Obviously, everyone gets one of those. Wonton soup, number 5. Fried rice, number 6. Hot and sour soup, number 9. And then rounding it off is pot sticker, number 10. That's just a good tidbit for everybody who likes their Chinese food, whether or not you're weird or not, like Mauricio and your favorite's Kung Pao chicken.
Mauricio, I am sending you dinner tonight. I can't believe you've never had General Tso's chicken.
Dude, it's Monday night, dude. It's sushi night.
Monday night sushi night. So it depends on the area. Something I learned from eating sushi a lot, and we became friends with one sushi restaurant, that whenever you have like half price sushi night or like buy one, get one free sushi night, that's because they get the fresh fish the next day. So if it's like half price sushi on Tuesday, that means their fresh fish deliveries comes on Wednesday. So just so you know what you're eating.
I've taken both Kyle and Mauricio to my favorite sushi place down here in Sarasota. So AJ, we need to get you down here. Come eat sushi with me.
Oh, thanks, Jay.
You got to go visit him, AJ.
Done.
Visit tomorrow. There's nothing special happening tomorrow, right, Jay?
AJ will be hunting, and I'll be hiding from a hurricane.
All right. Well, since we're on the Asian food thing, here we go. F, marry, kill. What are you picking? Italian food, Mexican food, Asian food?
Ooh.
Oh,
Mauricio.
Wait, what was the first thing you said?
Italian food, Mexican
No,
food,
before that.
and Asian
Before
food.
that.
F, marry, kill.
What the hell does that mean?
Marry, kill.
Oh,
So like you could pick one that like you marry, that is like you eat all the time, one that you just have every once in a while, and the one you can never have again.
and what are those again? What are the options?
Italian, Mexican, and Asian food.
I definitely need the Asian. So whatever that one is, I want Asian all the time.
Yeah, I'd marry the Asian.
Mexican, I could never do again, and Italian is like whatever.
Whoa, what could you never do again?
So you killed Mexican?
Mexican you'd kill
I'm gonna kill Mexican.
and marry Asian and
Yes.
F Italian. I'm with Mauricio there.
AJ, what's your?
I'm choosing polygamy.
No, you got to pick. You got to pick.
Can I hold on? I want to guess.
I'll kill Italian food,
Okay,
and then I'll marry
Mexican.
just to switch it up. Why not?
So I have two different answers. For myself, if I was just a single guy, then I would be killing Mexican. But since I live in a family of vegans, me not being a vegan myself, I got to kill the Italian just because the Italians don't do a great job of making vegan food. They're very
There's like veggie lasagnas.
What are you talking about?
Yeah, veggie lasagna's got cheese in it. Everything's got cheese.
Oh, vegan. You said vegetarian.
Vegan. I'm not vegetarian. It's very difficult. Their plain pasta is basically with red sauce is all they got with vegetables. So, and Mexicans do a lot of avocado and rice and beans and stuff like that. And Asian foods, my daughter just absolutely loves avocado. Like we go to a sushi place. My 8-year-old daughter eats 6 avocado rolls. 6. I can't go to the places that have expensive avocado rolls just because I don't want to spend $40 on an 8-year-old for dinner. So. All right. Anyway, AJ, you got something you want to plug here?
Yeah. So Instagram took me out. So I'm gonna plug my non-existent Instagram profile right now.
What happened?
What happened?
So apparently I'm impersonating this famous guy named AJ. That's literally what they said. You're impersonating a guy named AJ Osborne. And so I was taken off. I was actually verified, but I've been off Instagram for a week.
Hold on. I'm doing a search here for AJ Osborne.
Well, you just don't believe him, Jay?
No. I want to see if there's another AJ Osborne.
Oh, there's a bunch. They're all impersonators trying to scam people.
Oh, okay. So and some of them, once somebody reported that you were the impersonator.
I don't know. We had no explanation, nothing. We just whenever it was last week came up. You've been permanently banned. I couldn't get into Instagram. No warnings, no nothing. And they said you're impersonating AJ Osborne, and so I'm verified. Like that was the whole reason we went and got done all the legal.
But there's but is the AJ Osborne podcast different?
Yeah, AJ Osborne's podcast is for podcasting, but it's not my.
Got it. Okay, because that one's still out there. But okay,
Yeah, that one's still up.
I have a friend at Meta. I might be able to help you. He helped me when I got banned.
That would be amazing.
Here we go, making connections on the podcast.
dude, this is like, hey, I've got box seats to the Kentucky Derby. It's like, dude, I got a guy in Meta who can help you out. I'm like, dude,
Jay, you want to plug something other than your connections?
Do you have box seats on the 1 yard line for the Kentucky Derby?
I got it for the 4x100 meter relay.
I'm gonna plug that we are gonna have a very special guest host replacing AJ for the next 2 weeks. 2 guest hosts for the next 2 weeks because AJ is doing an amazing hunting trip with his son for his 13th birthday. But that means we get 2 amazing co-hosts to fill in. I'm not going to say who they are. So you're going to have to tune in. So there you go. I'm plugging this show for the next 2 weeks.
And for my vegan family, don't worry. AJ is a strictly shoot and release hunter.
Exactly. Just like my fishing. Shoot and release, baby.
Mauricio, what do you got for me?
I'm going to plug my Wednesday Real Estate Syndicate Alive, which I do live on YouTube under my YouTube channel, Mauricio Rowe. We're actually going to talk a little bit more of a deep dive on this fund of funds if you guys have questions about fund of funds in general after I do my little spiel.
And once again, begrudgingly, I'm going to plug my wife again here, even though she hasn't reposted my short from last week yet, which, I thought we had an agreement here, Ashley, that you were going to repost my stuff and I was going to plug you. But I'm still going to say, go follow my wife on YouTube, Instagram, Badash Investor. I don't know about you guys, but my beer is gone. I don't know if your waters have run out, but I'm going to go hit the head. So I will see most of you next Tuesday.
AJ, have a great trip.
Yeah, have a great trip.
See you, buddy.
See you in a couple weeks.
Will do. Have fun, guys. Appreciate it.